September 3rd, 1929. The Dow Jones Industrial Average closes at $381.17, the highest point in American history. Millionaires are minted every week. Shoeshine boys give stock tips. One of the most respected economists alive, Irving Fisher of Yale, tells the press, "Stock prices have reached what looks like a permanently high plateau." 8 weeks later, the market is in free fall. By 1932, the Dow sits at 41.22, an 89% collapse. Not because America stopped producing, not because people stopped believing, but because the system itself was built to unwind. This is not a story about a market crash. It's a story about three interlocking forces: leverage, power, and control, that turned prosperity into a feeding frenzy, and then into a foreclosure. The Roaring Twenties. America emerges from World War I as the world's creditor. Factories hum, automobiles roll off assembly lines, radios broadcast jazz into living rooms. The Federal Reserve, created just 16 years earlier, slashes interest rates to 3% after a brief recession in 1920-21. Easy money flows. Myth: everyone was getting rich. Reality: a debt machine was being constructed piece by piece with everyday Americans as collateral. The centerpiece of this machine was margin lending. If you wanted to buy stock, you didn't need to pay the full price. Brokerages would lend you the difference. How much? In the mid-1920s, you could control $10,000 worth of stock with just $1,000 or even less. That's 90% leverage, 10-to-1 odds. Between 1921 and 1929, margin loans exploded from $1 billion to $8.5 billion. That's 8% of the entire U.S. economy riding on borrowed money. Think of it like a mortgage, but on steroids. You borrow to buy. The stock itself is the collateral. As long as prices rise, everyone wins. The broker earns interest, you earn capital gains. The bank behind the broker earns fees. But here's the trap. If the stock price drops below a certain threshold, the broker issues a margin call. You must deposit more cash immediately, or they sell your stock to cover the loan. If you can't pay, you lose everything. Not just your gains, everything. By 1926, the call margin market, where brokers borrowed overnight to fund margin loans, was charging 10 to 12%. In March 1929, rates spiked to 20% for a single day. 20% for money borrowed overnight. Think about that. Brokers were so desperate to lend because commissions were so lucrative that they paid 20% interest to banks just to get the cash. Who was feeding this machine? Charles E. Mitchell, chairman of National City Bank, the largest bank in America, predecessor to Citigroup. Mitchell pioneered retail banking and personal loans. He also turned his bank's investment affiliate, National City Company, into a securities-selling juggernaut, moving $1.5 billion to $2 billion worth of securities annually. Mitchell himself took home bonuses totaling $3.5 million between 1927 and 1929, on top of his $25,000 salary. He avoided paying income tax in 1929 by selling stock to a relative at a loss, then buying it back. The incentive structure was clear: sell more securities, lend more money, take bigger bonuses. Risk? That was the customer's problem. But here's where things get darker. Enter the investment trust. Think of it as the 1920s version of a leveraged ETF, a mutual fund that itself borrows money to buy stocks. By 1929, nearly 750 investment trusts managed over $8 billion. That's nearly equal to all the margin loans in the entire market. Myth: investment trusts were diversifying risk for ordinary investors. Reality: they were leverage stacked on leverage, with insiders skimming fees at every layer. The crown jewel, or poison pill, was Goldman Sachs Trading Corporation. Launched in December 1928, it raised $100 million. Shares traded at a premium, Investors paid $140 for shares worth $100 in assets, simply for the privilege of being in Goldman's club. Then, in July 1929, Goldman launched Shenandoah Corporation, another $100 million raised. Goldman Sachs Trading Corporation bought heavily into Shenandoah. 1 month later, August 1929, they launched Blue Ridge Corporation. Shenandoah bought into Blue Ridge. 3 nested trusts, like Russian dolls, each one leveraged with convertible preferred stock. Shenandoah had $42.5 million in preferred debt on $131 million in assets. Blue Ridge had $58 million in preferred debt on $131 million in assets. If you owned shares in Goldman Sachs Trading Corporation, you didn't own stocks. You owned a leveraged bet on a leveraged bet on a leveraged bet. One analyst later called it a siphon. Money flowed in at the bottom, and the directors, Walter Sachs, Sidney Weinberg, and Waddell Catchings, extracted fees at every level. Not everyone was blind. In February 1929, the Federal Reserve Bank of New York, led by Governor George Harrison, requested permission to raise the discount rate from 5% to 6%. Harrison saw the speculation. He wanted to cool it down by making borrowing more expensive. The Federal Reserve Board in Washington, the central authority, refused. 9 times between February and May 1929, New York asked. 9 times Washington said no. The board issued a public warning instead, cautioning against speculation. But words without action are noise. Finally, in August 1929, the board relented. The discount rate rose to 6%. Too late. The trap was already set. Then the music stopped. Thursday, October 24th, 1929, Black Thursday. The market opens 11% lower than the previous day's close. Panic selling begins. The ticker tape, the only way traders can see prices, falls 2.5 hours behind reality. No one knows what anything is actually worth. Margin calls flood out. Thousands of investors who bought on 90% leverage now face a choice: deposit more cash or lose everything. Most don't have more cash. Forced liquidation begins. A consortium forms. J.P. Morgan, Chase National Bank, and National City Bank, Charles Mitchell's bank, pledge to stabilize the market. It works for 4 hours. Then it fails. Monday, October 28, 1929, Black Monday. The Dow falls 13%. Tuesday, October 29, 1929, Black Tuesday. Another 12% gone. 16 million shares trade hands, a record that stands for decades. Around $14 billion in stock value evaporates in a single day. Some stocks have no buyers at any price. Goldman Sachs Trading Corporation, which had traded at $326 per share, falls to $1.75, a 99.5% loss. The pyramid collapses in reverse. Blue Ridge, the bottom layer, stops paying dividends. Shenandoah can't service its preferred debt. Goldman Sachs Trading Corporation implodes. Investors who bought at the top lose everything and still owe money to their brokers. Over the next 3 years, the Dow continues to fall, reaching 41.22 on July 8, 1932. From peak to trough, 89% gone. Between 1930 and 1933, more than 10,000 banks fail, half the banking system eliminated. There is no FDIC yet, no deposit insurance. Depositors lose their life savings. Charles Mitchell? He resigned from National City Bank in 1933 after Senate hearings revealed his tax avoidance and the bank's role in the bubble. He was charged with tax evasion, acquitted. He went on to work on Wall Street for 2 more decades. The Federal Reserve? Blamed for acting too late and then, during the Depression, for not acting enough. Who benefited? Those who saw it coming and got out early. Joseph Kennedy liquidated his positions in the summer of 1929 and built short positions. Bernard Baruch converted to cash and bonds by August. European banks quietly sold U.S. holdings throughout September. Myth: the crash was unpredictable chaos. Reality: smart money exited months before. The slaughter was retail investors, people who believed the dream. The Great Depression follows. Industrial production falls 47%. Unemployment hits 25%. Debt deflation takes hold. Prices fall 25%, but the real burden of debt doubles. Farmers, businesses, homeowners default in waves. The economy doesn't truly recover until World War II forces massive industrial mobilization. In 1933, Franklin Roosevelt takes America off the gold standard, essentially a sovereign default. The government creates the Securities and Exchange Commission, the FDIC, Social Security, unemployment insurance, emergency measures to prevent societal collapse. In Germany, economic catastrophe helps bring Adolf Hitler to power in 1933. Here is the principle that generalizes. When leverage becomes democratized, when ordinary people can borrow $9 for every one they own, the system doesn't distribute wealth. It concentrates risk at the bottom and profit at the top. The three forces in 1929 were margin lending, investment trust pyramids, and a central bank that acted too late. Today, the names change. Margin loans become crypto leverage and options trading. Investment trusts become SPACs and meme stocks. The Federal Reserve still walks the tightrope between inflation and speculation, but the structure remains. A machine that turns confidence into debt, debt into asset prices, and asset prices into collateral for more debt, until one day the collateral is worth less than the loan.
And then everyone finds out who was swimming naked. The 1929 crash didn't break the market because of bad luck. It broke because the market was designed to break. Three forces, leverage, pyramids, and delayed intervention, turned a boom into a bubble and a bubble into a holocaust of wealth. The handcuffs were already on. October 1929 was just the day they tightened.